All right, we are live. All right, welcome back, everyone, to the MisterRentToOwnHomes Show. My name is Dominic Danino, aka Mr. Rent-to-Own-Homes. And in this live, we're going to be talking about assumable mortgages. What is an assumable mortgage? This is a kind of a hot topic these days because of the way the interest rates are right now. So, yeah, that's the topic of the day. And as usual, I am joined by James Brown, real estate investor, real estate agent in Colorado. So welcome back, James. How you doing, buddy?
I'm good, thanks. I think you're going to be doing most of the talking on this one. But,
well, I mean, I don't think so necessarily. I mean, I have the experience with this, but for you, or I think, where you come in is the misconceptions, right? You've heard them, right? Or the rumors or things that people say that they think it's true or not true, but maybe they have done them or they haven't done them, right? So, and you as an agent, you may get inquiries for potential buyers about that, or other investors or in other network groups, people ask about these things, right? They hear this, and this is available, or this is an option, and what that may be. And as a matter of fact, you sent me over a website a while back, right? And how to find assumable mortgages at low rates and so forth, right? So I'll dive into that because I did register with that website to see what would happen, right? Yeah. So I got some inquiries. Anyway, so we'll talk on that topic. So let's start from point A here, right? So what is an assumable mortgage loan?
Yeah, my understanding is a buyer can come in and just take over that existing loan and not have to create a brand new loan. They just take over the existing one that the seller has with the same terms, same end date, right? And same interest rate, which is the big reason why people are looking at these.
Yeah. So mortgages. So somebody has an existing mortgage at a particular rate, potentially based on the rates the way they are now, they're higher than where we've been 2 years ago and so forth. So there's a lot of people. I heard the stats, right? I think more than 75% of mortgages are under 5.5%, and 60% are under 5%, and some stat almost like 40% are under 4%. And so there's a big chunk of low rate mortgages out there, right? And so compared to what the current market is, it's higher. So this used to be a thing in the 80s and 90s. Okay. Basically, what it does is it allows you to take over an existing mortgage structure. So when you have a mortgage, you have a note that has all the terms, right? With the lender terms. And if it's a VA, FHA, USDA, or conventional, all those loans have terms on the note that says, what's the rate? What's the term? Term meaning how long is the payment for? And what are all the rules and restrictions of that loan? Like the due on sale clause is one of those, right? So that's in the contract. So if I have a, say, VA loan as a veteran, I could get a VA loan. I have a VA loan at 3%, and I need to sell my house. I could offer on the market through an agent and on the listing and say, hey, assumable loan, take over my loan at my 3%. Now that sounds fantastic, but there are restrictions to that, right? It's not just somebody says, oh yeah, okay, give me, let me just take it over here, give me the keys, and then go about your business, and then everything just kind of keeps going, right? There are rules to those assumable mortgages, and there are pitfalls, not for the mortgage itself, but pitfalls as into who's eligible, what kind of loans are eligible. Not every loan is eligible. Not every person is eligible, right? So So that is the challenge, or the when I see a lot of agents posting on social media, hey, take over this assumable loan at 3.5%. So they get a bunch of inquiries, right? They get a bunch of inquiries, hit them up and so forth. But the reality is most of those people won't be eligible for it. So we're going to talk about what loans are eligible, what are some of the rules, right? And how can that be used for people in this current market, right? So I outlined a few items here as to what loans are eligible or what loans are assumable. And most of or I'm going to say 99% of the loans that are assumable are going to be government-backed loans. When we say government-backed, meaning the government backstops those loans in the case of default, and the government will pay the lender for that default up to a certain amount, right? So those are FHA, VA, and USDA. Conventional loans are not assumable, right? Conventional loans are not assumable. So it limits the number of potential properties out there that have those kind of loans, and for somebody to assume them. Now, the seller has to be willing to sell it with that assumption, right? You can't just say, well, I'm just going to assume it, and without the seller's permission, because there is still some liability from the original mortgage holder, right? The original applicant that owned, or that is the borrower for that particular assumption loan. So FHA, VA, USDA. Let me start with VA because that one's kind of pretty easy, right? So VA loan can be assumable, but the person that's assuming it has to qualify. They have to qualify just the same way as if they were going to qualify for a loan without the assumption, right? So they have to have credit, income, assets, right? Ability to repay, right? So they have, now on VA loans, veterans have what's called an entitlement that's placed on a loan that they do, because that's the guarantee by the government. That's why VA loans can do up to 100%, because the government is backstopping a default up to 100% of that loan liability. That means they're going to make the lender whole if this person defaults, right? That's what that means. So VA gives veterans a certain amount of entitlement, meaning you can use up to this amount of insurance at one time, right? So based off of that insurance amount is how much somebody can borrow. Let's assume somebody uses all their entitlement on one property, right? And they let somebody assume that loan. If that person is not a veteran replacing their own entitlement for their entitlement, then that entitlement does not get released. So that
it gets locked up, so they can't use it.
Yeah, that veteran can't go use it again, right? So that's a challenge. Now, there may be a veteran that say, hey, I'm not going to be buying because I'm moving in with a girlfriend, wife, or family, or whatever. I'm getting relocated. I'm getting military housing, so I don't need it, right? Maybe down the road they may, right? But for VA, is you're a veteran that's coming in to assume the loan, then your entitlement can replace that and releases the entitlement of the person that's leaving. If you're not a veteran, that entitlement stays tied up, and so that's a challenge, right? A veteran may say, I'm only going to let other veterans assume it because I don't want the liability or the risk of that, and I want my entitlement. Make sense?
Is there like, everybody's different, like even in the military, one might make a certain amount. And
so every veteran's entitlement amount is the same.
It is the same.
It is the same. But there are certain rules. Let's say two spouses that are veterans, that gives you more entitlement, right? It's a bigger insurance. It's like two insurance policies, right? If a veteran is borrowing with a non-veteran that is not a spouse, then there are rules for that. You can't use full entitlement. What they do is they split it, meaning you can only use partial entitlement for the veteran, and then the down payment requirement is based off a non-veteran applicant. Make sense?
Okay. Yeah.
So if I'm borrowing as a veteran by myself, and let's say the required entitlement that I need to use, it's, let's say, $50,000. If I borrow with a non-spouse, non-veteran, then the entitlement that I can use is 25 for me and 0 for the other individual, right? So that means there's got to be a 25, let's say, $1,000 down payment, because that's not covering the 100%. Make sense?
Yeah.
So there are certain rules with that, right? So yes, if you're a veteran, and you can qualify, absolutely. The other challenge that I see a lot is when these posts are out there, and every once in a while I reply back to the agent just to kind of see if they understand what they're trying to do, right? Is, let's say I took out that loan originally for $300,000. And I've been on this loan and I've been paying it down, and now my balance is $200,000. Okay. And let's say I'm selling the house. Let's just say for $300,000 for simplicity purposes, right? It's probably more, but let's just say for simplicity, I'm selling the 300. So I have $100,000 worth of equity, right? If you're gonna take over my VA loan, VA doesn't give you the rate and bump up the loan amount back up to the 300,000, right? So if the purchase price is 300, you're taking over a 200,000. There's $100,000 of equity that you have to bring in to the transaction. You got to have that money. It won't finance that. And there's second mortgage or private, what we call PM2s or purchase money seconds. VA does not allow to purchase money seconds. You have to have that. So
you have to have the
cash. A lot of built equity, especially these days, right? A lot of people have built up equity. Then that's a challenge, unless you have the money. If you have the money, great. But that's very few people, right? So the best ones to get into, if I were going to tell somebody, is newer VA loans, right? Somebody that just took out a VA loan in the last year or two because they haven't built up a whole lot of equity. And those are the ones that you see a lot out there, right? It's like, hey, I got to get relocated, or I'm moving duty stations, and I got to do something with this because I can't pay 2 locations, right? And I don't have a whole lot of equity, so I don't really care, right? I don't have a lot of equity or no equity. And so those are the ones that potentially somebody could take over, right? Now, if somebody took out a VA loan in the last 2 years, they probably don't have the 3% rate, right? Right? So think about that. So you got to apply a little bit of a common sense with it, right? So maybe somebody took out one back in May of 22, which is kind of where we started going up. So early 22, that's 2 years. Probably haven't paid it down a whole lot. Let's say maybe they paid it down 10,000, 15,000, maybe even up to 25,000. If you have that, then sure, right? Do it. Or you could do it, or somebody selling, they could sell their property on those terms, right? So that is the challenge. If somebody has a lot of equity, a lot of people don't have it, and you can't borrow that, right? Now, could you get a gift for the equity? Like all traditional loans, family members can gift you the equity. So if somebody has, I don't have it, but I'm going to get a gift from a family member to make up that difference, you can do that, because that's allowed, right? So that's VA. FHA works in the same fashion, other than the fact that there isn't an entitlement to be released to the person, right? Now, on the FHA side, people have to qualify, right? Fully, just the same way: credit, income, assets, job stability, everything as if they were going to get a new loan. And then the issue, again, is the equity issue still remains. You don't get it reset back to the higher amount. You got to have to come up with the difference. Well, most FHA buyers only have 3.5% generally, right? So if somebody has a lot of equity,
that's why they're going FHA.
Yeah, they're not going to be able to do it, right? And if they qualify, then that can release the liability of the original note holder and saying, hey, I'm not liable for that loan because if it goes bad, the servicer qualified them. They agreed to release me. So they get a release of that and they're no longer liable, right? Yeah. Unlike some of the other stuff that creative stuff that people do, like the sub twos, right? That does not release the liability of the original borrower if that loan does not get paid, right? So things to consider, right? There's a right place and a right time to apply all these different methods of financing, but it takes the right individuals, the ones that know how to do it, doing it the right way, right? Come with experience like us. So that's the factor on the FHA side. So it can be done. Oh, and then so those are the type of loans that are USDA works in the same fashion. Very seldom see any USDAs. It's kind of like it's like a unicorn these days, right? Because we're not in a rural area per se, right? But you're in a metro, I'm in a metro, so not generally, we don't get a lot of activity on that side. But that's potentially available too on USDA. Somebody has to qualify and go through that whole process again, just the same.
Weird for some reason.
Say again?
It's weird. It's just like clicking. Can you hear me?
Mm-hmm.
Oh, weird.
Maybe my fan. No? Okay, you muted yourself. Maybe your batteries died on your headphones.
Mute.
There you go.
Let me go. Trying to get back to my headphones here.
I can hear you now.
There.
All right. So that addresses VA
FHA.
and FHA, right? Some of the rules behind that, some of the challenges and what's required. The one that comes up, and there's people spreading rumors out there that you can be an investor and take over, right? These assumptions are for owner occupancy only, right? You have to be owner occupied. Your intent has to be to live in it. Yep. Now, somebody skirting the truth, it's difficult because I know as a lender, there are questions that we ask and we can kind of see these things a mile away because we're doing long enough to see people trying to misrepresent, basically, right? Now, I give everybody a word of caution when it comes to that. Misrepresentation on mortgage, it's fraud. You can criminal liability.
Fraud.
You can go to jail for that, right? So it's no joke. So there's a right way and a wrong way of doing stuff, right?
Yeah.
There's a right way or wrong way of doing stuff. So I would caution anybody that now, can somebody have a reasonable explanation as to what's happening? And it happens a lot in the mortgage world where as it relates to occupancy and so forth, right? Obviously working with a lender that understands some of these rules and what makes sense and what doesn't make sense. Because if you come at me or with I'm going to live in it, but I own the house next door, am I likely to believe you that, okay, are you really trying to buy an investment property? Like, why would you just leave your house next door to move into this one? Why? There's got to be a rational thought behind that, right? Or within the next, or it's over on the other side of the, in the same block or in the same city or in the same vicinity, right? That's generally not what people do, right? Generally, people live in a primary and buy investment properties within the vicinity, and that's okay. There are loans for that. Investment property. But when you're trying to say, hey, I'm going to move in it so that way you can skirt the rules or misrepresent your intent of occupancy, because that's important. Occupancy rules are important in the lending world because it's liability to the lender, right? Basically, the thought process is A person is less likely to default on a primary residence because they're living in it versus an investment property if things go south, right?
Exactly. Yeah.
Hey, I need to make the payment on my house because I got the spouse and the kids and the dog, and it's where I live and I sleep. So if I got to make a choice of 2 payments and I can only make one, is it I'm going to stop the payment on the investment where I don't live in or the one that I live in, right? Which one do I want taken away? Right? Or which one do I not want taken away, right? So that's the general thought process. And that's why on an owner-occupied property, lending allows you to come in with less money down, right? Because they view it as lesser risk going to default on that. And non-investment requirement for higher money down is because of that risk, right?
Yep.
Because
so the exception is
payment. And so if you're short on money, then which one are you going to pay and which one are you not? So go ahead. Let me stop talking for a second here. I'll let you kind of get a few words and thoughts in.
Yeah, I was just going to say, like, these aren't for investors, but the exception is a house hacker, somebody that's going to live in a property and rent out some other rooms. That is their primary. They're just renting out those rooms. So that's a great way to take over a low interest rate loan.
Absolutely, if you could qualify, right?
So,
and we talked about house hacking and different methods of basically lowering your housing expense last week, right? How about buying a duplex or a fourplex or a triplex, living in one unit, renting out the other ones? Those can be assumable too. They're going to have the rules, and you still got to qualify just the same way, right? But potentially, could you take over one? Absolutely. No, and those, if you have the equity and the qualifications and the money for the down payment on the equity shortage, absolutely, yeah, that makes sense. So let's keep that in mind there. So potential, yes. So let me ask you this: what are some of the myths or misconceptions or things that you have heard out there as it relates to assumable loans that maybe I could kind of try to answer for?
Yeah, I think we already kind of touched on the main one I'm thinking about is that an investor can take over an FHA or VA loan. That's the big one I always hear. No, you cannot. It's got to be owner occupied. So,
yeah. Your intent has to be to owner occupy it. Okay. Got this. And based on your overall profile, if you have 3 rentals and you have a primary, you say, oh yeah, I'm going to assume this loan and I'm going to cop. That's going to throw up a flag, right? I mean, it's just common sense. Like, oh wait, this guy's an investor. They got rentals. Are they really going to occupy? Does this move into this property from their existing primary make sense? Right? No. Somebody's getting a job relocation. Absolutely. So if I'm going from Arizona to Florida and I can document that, yeah, my job at Motorola is transferring me over there and I'm the warehouse manager or the plant manager here, and I'm getting relocated to that one and I got a job letter from my employer, then okay, that could make sense, right? Got a new primary, right? So there has to be some common sense, some reasonability there. And those are the things that the lenders are going to look for, right? And they won't hesitate to deny your assumption application, right? If they see anything that they can potentially constitute as fraud, they'll just deny it. So it's not like they're obligated or have to give you the approval and have to let you assume it, right?
Right. Yeah.
That selling party is the one that's responsible for that loan. They don't have to help them to find somebody. All right. So it has to be somebody that's qualified, right? So generally the process with that is, hey, so let's say I think I'm eligible. I think I want to buy one. I think I have a seller that's willing to do that. What would that process be generally? Right. So what you would do is you would ask the seller for who the servicer is on their loan. Now, you want to talk about what a servicer is?
Just somebody that's collecting the payments, as opposed to the loan originator. That can be a totally separate person.
Yeah, so that individual that's selling it, right, gets a monthly statement right? And that monthly statement is so and so servicing or whatever, or it may be the actual lending company, right? And so that's the servicer. They handle all the payments. They handle the distribution of paying the insurance and the taxes and collecting the escrow funds and so forth, right? So they're servicing the loan, right?
Yeah.
So you as the buyer get that information from the seller. Say, hey, who's the servicer, and probably get the loan number. Get the loan number that's on there, and you would call that servicer and say, hey, I'm interested in assuming this loan. What's your process? Can you send me this? Or is there a assumption department? Because a lot of the big lenders will have an assumption of, oh yeah, that number is this, or press 2 or 5 or whatever it is on our 800 number, right? And you get to the assumption department, or they may say, oh yeah, what's your email? We're going to email you the instructions of what you got to do, what you got to submit, who you got to submit it to, either fax it, email it, or call whomever you got to do, right? And that sort of starts the process to get the ball rolling. And they're probably going to ask for a copy of that contract that you are buying that person. So you're going to need that agreement that individual that has the existing loan and you are agreeing to on that price. And so they're going to need the contract, because they're going to see, okay, the price is $300,000, the balance is $200,000. You have $100,000 to put down for the difference. If you don't have it, then they're not going to approve it. You need the funds, right? Yeah. So that's generally the process. And, there's some variance from servicer to servicer. Timelines generally, from what I've seen, they take longer than a traditional transaction. They're going to be 45 to 60 days probably, right? Sometimes they work faster, sometimes they work slower, depending on the servicer. Just like anything else. Just like anything else. If you have all the complete information that they need, they can just probably approve you the first time around without. But if you're kind of piecemealing them, I just sent you my pay, so next week I'm gonna send you my W-2, next week I'm gonna send you the contract, and so forth. They're just gonna create the delays, right? So and they do charge a fee for that, right? So and that's gonna vary by servicer to servicer, right? They're not doing it for free because they got to do paperwork.
What's a range?
That's a great question, right? So I would anticipate at least $1,000, right? I would anticipate at least $1,000. Could be more because there's probably some recording and some notary fees and so forth, right? Because somebody has to go do all that work, recording with the county, the notaries, and so forth, right? So they'll probably have like a processing fee, and then you have the recording fees, which could be paid at closing, right? So through the title company, the recording, the notary. So if there's a contract and there's an escrow, then once you're approved, the assumption department would probably give you an approval letter, give you the terms, and send that over to title, right? So that way they can do so the contract said 300, so you put your 100,000 plus your fees, your closing costs, right? The seller gets their money, and you take over the loan. And now loan is in your name, and now you start getting the statements, right? And paying agent commissions and so forth if there's agents involved in that transaction.
Sure. Can I add something?
Yeah.
So as a seller, this is like an incentive to bring in buyers. They're trying to find a lower rate and keep their payment down, right? The downside for the seller is that, like you said, it could take 45, 60 days. So you have to be prepared for that, because if you're wanting to buy or having to move quickly, be prepared for that delay with that assumable loan. So
yeah, and generally those people, those assumption departments, of people who handle the assumptions for these servicers, right? They're not like lenders, like that are trying to help you, agent, to meet your deadline because we have a relationship for your client. Those people are like, right? They're almost bureaucrats, as you would say, right? They're like, okay, whatever, right? We'll take our sweet time. We'll get to it when we get to it, right?
Would yelling at them help speed things up?
I don't know. That may get you a turn down. Then you can come to us. Right. So everything has a, nothing ever goes perfect. Nothing ever is perfect, right? You just got to work through the challenges, and but there's always a benefit to doing this versus that, and you have to balance those things out, right? If you're looking for speed, it won't be this, right? If you're looking for speed. So any additional questions or thoughts on this?
Nothing's jumping out. You did a good job covering it.
Yeah, I think it's a hot topic because we encounter this every once in a while, and getting some facts out there too, right? And I get it. People are doing their best, and agents are trying to propose and give sellers more options, which is great, right? Especially in this market with longer days on the market, then you want to give sellers more options to offer their property.
Yep.
Right. So that's and then there's value to a buyer, and so it's going to potentially attract more buyers, but they actually have to qualify too, and then the speed as quickly. So you'll see some agents out there, assumption specialists, right? I mean, they're not approving the assumption. They understand the process, and they're saying, okay, this is what you got to do. Here's the process. Call this number or start that process. And once you get approved, then maybe you could theoretically work it backwards. It's like, go get approved first. And once you're approved, then make the offer to us. So that way we don't have the property tied up under escrow, under contract, in case another buyer comes in and can pay cash or close faster than you can.
Mm-hmm.
Right? Instead of making the offer, accepting the offer pending the approval, I would probably say, hey, go get approved first. Once you get your approval, then make us the offer because you're already approved. Right? Yeah. We don't want to tie this property up because somebody else may come along that's ready to go and they're going to pay the price and they don't need to assume it, and we just go. Right?
Yeah. Good point. Yeah.
So, I mean, see, there you go. That's your pro tip of the day right there.
Yeah. Awesome.
Not to type your property. All right. Any final thoughts? Any questions before we wrap this up here?
No, I appreciate you sharing your in-depth knowledge on that. I think a lot of people, like I said, are making assumptions about assumptions, and so this is good to clear it up.
You hear a lot of the stuff in these Facebook groups and these masterminds and and the dark web, wherever people are hearing information, right? Like, So work with knowledgeable people like us, right? We've been around and we got the gray hairs to show it. So if you have any questions, by all means, reach out to us. If people want to get a hold of you, James, how can they do that?
Go to the link there on the screen, Linktree/partner with James Brown. Ton of links within that. So
yeah. All right. And if you want to get a hold of me, I am at MisterRentToOwnHomes on Instagram, TikTok, and on YouTube, or you can look me up on Facebook, Dominic Danino, or you can go to our website, rent2ownhomesus.com. Check out how our rent to own home programs work. We have a explainer video, that page, and you can also register to kind of set up an appointment on there. So we can kind of talk about your situation. Maybe you qualify for a traditional financing. Maybe you could qualify for an assumption. Maybe you need rent to own because you don't qualify, right? So we have multiple options to help you. I am a lender. I can do loans in all states but New York. James is licensed in Colorado. We have in-house agents here in Arizona, agents around the country that we work with. So we are not limited to just our markets as it relates to rent to own. We've done them in multiple states. We're up to 12 states right now, and adding more. And if you're out of those states, out of that market, and you want to be our boots on the ground, our go-to person, being our representing agent in that market, we have opportunities to kind of help you grow your business in markets that we're not currently active in. It basically would take us maybe 45 days to get that up and running, kind of get you on board and kind of explain to you how the process works. I mean, that doesn't really take a whole lot, but just kind of getting the paperwork done so that way we can implement it accurately, effectively, and then protecting all parties. So anyways, that's it for today. That was our live on Assumable Mortgage Loans. So until next time, see you then. Bye-bye.